Hello, everybody. This is Dan Sheridan. I'm continuing in the double series, and today we're going to talk about double calendars. There'll be three parts of it. I'll give you an example. We'll talk about the Greeks, some of the strikes, some of the how volatility affects it, news, etc. Then we'll go into the back test and see what we have here in option Omega. What is the back test? Does it work? Does it have decent results of what I'm basing the strategy on? And then the third part, I've got this set up for a live trade in the automated platform of options Omega, and we'll look at that. So we'll take this all the way through from what it is to does the strategy work to, hey, it passes the green light with I like the strategy, I like the back test, let's automate it and go from there. So the first thing is, this is the double series. So double just means I'm looking at it as two. In this particular example, I have a calendar on the upside, a bullish calendar, and you have a bearish calendar. So with the underlying in this example at 64.75, we have the call side at 65.45. So we're doing a bullish call calendar on the upside, and then we're doing a bearish out of the money put calendar on the downside. So in this particular example, we're about 65 points, somewhere around there, 65, 70 points out of the money each side. So this would be double calendar. I've got two of them, right? If I did a double diagonal, I'd have a diagonal on each side. Some double strategies would be, I'd call them combo. Sometimes I might put a butterfly on the upside, calendar on the downside. But what they all have in common is two things in these doubles. The foundation is a short strangle. You're selling an out of the money call, out of the money put. That's what they have in common. The other thing they have in common, they're maybe a first cousin of the iron condor. You say, Dan, what do you mean? Well, they kind of look like an iron condor, kind of have that shape to it. This is the expiration graph. This is the graph today. It kind of gives you a wide area of where you make money. Versus a butterfly calendar, it's kind of like an igloo. Kind of looks like this because you're selling the at the money. So it's a little bit different. So in this double calendar, let's jump in on this example. This would be called a 923. And you'll see in the back test, we set it up to put it on a Monday and a Wednesday around lunchtime. And we'll go over that. But you can see here, I'm selling a SEP 5. Today is a Wednesday, so I'm selling a SEP 5 call and put out of the money. It's 9 days out. And then there's going to be, the long will be 23 days out. 14 days between the long and the short on this example. And we'll talk about that in a little bit. Why would I do this? It's a range-bound trade. I would do it for weekly income. This type of trade, kind of a double calendar, generally, it's more, I would call it a shorter term trade is what I use it for. You can do, people will do them different days of the week, but you can do it 2 days from expiration. I guess you could do it 1 day from expiration, but generally maybe 2 days from expiration, you could sell the short and then buy the long X amount of days past that, all the way up till maybe 11 days or 12 days out, you can do a double calendar. To me, once you start getting maybe 15 to 20 days out, I'd rather just do a single trade at the money, sell the at the money with the most extrinsic value. When you're shorter term like this, 2 to 10 or 11 days, your biggest risk is price risk. So in that situation, I'd rather go further out. I want to go further out than a single structure. And that's kind of the thinking. So in this double calendar, it's going to be a shorter term trade, 2 to 12 days out. And in this particular example, I'll go over more specifics. I'm using a 28-29 delta for the call and the put. It's a little higher. You say, well, Dan, what if you did a lower delta? Like a 20 delta call and put, what would it do to this graph? It would take my short strikes, so I would be taking them further out, so I'd have more room. That's good. But by doing a lower delta, I would lower it in the middle. So I give up some of the middle to get more distance on the wings. Why would I do that? I would do that in a lower volatility environment where I wasn't that concerned with maybe more sag in the middle, and maybe I felt that we could move. Maybe there were some events coming up. Maybe there was some things that could move the market, or I was expecting it. So sometimes in a low volatility environment, and I want more room on the wings, I may go for a lower delta on the shorts, 20 delta or whatever. If I want a little more theta, maybe I'm not as concerned with a bigger move, a 28, 29 delta works fine. As always, you want to back test it. This is a positive theta trade, and that's what's very attractive on these short-term trades. They're positive, they have very good positive theta. Your shorts are going to decay. This is a 9-day out, the September 19 or September 5 here. So 9 days are going to decay a lot quicker than a 23 days. And so you have positive theta. But on the other hand, because you have 2 days between the long and the short, so there's 14 days between the long and the short, I have more positive Vega. What does that mean? It means I'm buying more extrinsic value in my longs than I'm selling in my shorts. So generally, I would like this. I mean, overall, when the volatility maybe is a little bit lower, in terms of looking at where it's been for the year, and I'd expect it maybe to go up, right? So I'm willing, when the volatility is low, I'm willing to go 14 days between the long and the short and get much more long Vega. Why? Because if the volatility goes up, kind of reversion to the mean, my longs have a lot more extrinsic value than my shorts, and I'll do really well. But if this low volatility gets lower, because I'm caught holding the bag, I own more extrinsic value because I own the longs. If the volatility goes down further, which it can do, especially in the summer doldrums, among other times, I'm caught holding the bag. I'm long more extrinsic value than my shorts, so I can lose there. And you can see, just like the big fat Greek wedding, the biggest Greek here is the Vega. So what that means is, if the volatility of each of my 4 options in a double calendar goes down a point, theoretically, I could lose $531. Does it always happen like that? No. Do they all go in uniform like that? No, but that's what the Greeks say. Now, what should you know here? Where, if you hear the phrase, Houston, we got a problem. Houston, we got a problem. What do you worry about in this trade? What should you worry about, right? You have 2 risks, and there's 2 risks on any range-bound trade, price and volatility. So first of all, if you get to the short strikes too early, it's like your mother-in-law coming over early for Christmas, and I love my mother-in-law, but if you get to the short strike too close or too early, or you start blasting through the short strike, those can be problematic. And so we're going to show you some risk management techniques or rails when we go into the back testing, how we're going to defend against this. That's number 1 problem. Number 2 problem is you have a lot of long volatility here. So what are you going to do if a lot of the extrinsic value is sucked out of this, or volatility goes down? And maybe because if volatility goes down on a mixed month spread, what happens to the graph? And a mixed month spread, if you reduce the volatility, your expiration break-even points, where your expiration graph, the blue graph, crosses 0, those will come in, right? So your break-evens will be closer in, and your expiration graph will go lower. So can the expiration graph in a mixed month spread change? You bet your britches. So again, that's what's great with the option Omega back testing. You can put risk management techniques to guard against the big problems. So it isn't a Houston, we got a problem. It's Houston, we're going to fix the problem, or we're going to put in some safeguards to protect us against the problem. So that is a very effective tool. We've done the 923 for a while. I think it's a good trade, and that's that, right? So let's move. I think that's good enough. And you can see here, one last thing I want to show you. If you look, All right, here's today, August 27, 2025, when I'm looking at this trade. But if you can just see, if you watch the purple graph, if I just progress this 1 day in the future, 2 day in the future, uh, August 29th, but if I go through the week, so if I go, today's a Wednesday, if I go to a Monday, right? So if I just go from a Wednesday to a Monday, that's 5 days. You can see how that purple line just jacks up, right? Uh, and goes quite a bit higher towards the expiration graph. Everything changes. So 1 day in a short-term trade like a 9 day means a lot. 1 day in a 30-day trade doesn't mean that much. Now, this particular trade, 923 that I'm looking at, it's a $5,500 trade. Now, the Greeks, I'm starting out 6 deltas long. And you say, Dan, is 6 deltas long a big problem? It isn't if your Vega is 532. What does that mean? Think in terms of delta as stock equivalent. If I'm long 6 deltas or 6 shares of stock, when we go up 10 points, I'll make $60. If I'm long 6 shares of stock, we go down $10, I'm down $60, right? So that's how you think of delta. Vega, you can see it's a big number. So when I'm doing a 923, generally, I'd like to be on the lower end of the volatility spectrum for the year. Today, as I look at this, VIX is 15. As of August 27, 2025, is this on the lower end of the range for 2025? As Sylvester Stallone would say, absolutely it is, right? The low, I think, is maybe in the mid to higher 14s. So this is on the low end of the range. Now, hey, Dan, could I make it cheaper than $55? Yeah, you could narrow, you could test it, and you could do, instead of 14 between the long and the short, yeah, you could do 7 days between the long and the short. You could buy SEP 12, sell SEP 5, or you could go even narrower. So there's things you could do. You obviously want to back test it first, see if it works. But the point is, this 6 delta says, general guideline in the world of option trading, you want to be long delta, long Vega. You want to be short delta, short Vega. Why? Let's just focus on why long delta, long Vega. Because if I'm long delta and we go up 40 points, right? If we go up 40 points in the SPX, which isn't that big a deal, I can make around 40, theoretically, 40 times 6, $250, right? On the upside. So I want to be long delta when I'm long Vega. Why? Because generally, when SPX goes up, volatility will go down. Now, it doesn't mean VIX totally represents my trade, but it means this 532 Vega means if the volatility of each of my 4 options goes down a point, I could lose 532. If they each go down a half a point, I could lose 250. So leaning long delta against the long Vega gives you kind of a yin and yang, gives you an opposite effect. The long deltas will help a little bit offset the long Vega on the upside. All right, as they say, let's move on. Now we're going to go from the graph, what it is, type thing. And let me just say this, double calendars. In the option Omega community, with the, is there a lot of people who will do longer term double calendars, 9 days out or 15 or 21 days out? There's some. Is that the predominant? No. This has been my experience with the 923, but I would say the majority might be, hey, you're doing it 2 days, 4 days, 5 days, 7 days from expiration on your short, or 8 days. And then your long will be, 2 to 5 days further out, or whatever it is. But you could have a schedule of these. And that's what's great with the automation. You can have a schedule of these going out during the week at good times based on your back testing. All right. So now let's move into the back testing. Why are we doing this thing? Right? You're just doing it because you feel like it? No. So if you look at this, these are my trades that are set up in the automation. So here's the double calendar, and let's look at the back test. So here's what I have it set up in the back test. This is it. I'm selling a put. So I did a test of January 1st, 2020 to August 26th, 2025, up until yesterday. And so what I like right away, and at least I did it long enough, we did it long enough that there's 219 trades. There's a good sample size, 150 winners, 219 trades. So 150 winners, 69 losers, very good win percentage. So what's the trade? I'm selling a put at a 28 delta. I'm buying a put, the same strike, right? 23 days further out. I'm selling a call at a 29 delta. I'm buying a call, the same strike. So a double calendar is just different expiration. You're buying further out, selling closer in. Same strikes in the calls you're long and short, same strikes in your puts long and short. You're buying a bullish calendar and a bearish. Open the trade at 12:35 p.m. daily. Allocate 10% of portfolio. RSI minimum 60. Now, just a quick point while I'm remembering this. As I'm taping this, August 27th, 2025, it's 12:39 Eastern. This had it to click to put this trade on 4 minutes ago, right? Did I do it? I didn't do it. Why? A couple of reasons. Normally, will I do these on a regular basis and just, trust the back test? Yes. I'm getting better at it. From not using automation, for 20 years, I'm using it, it's a process. But there's a reason today, right? One of the things that they have in Option Omega is something called blackout days. So you can put in if there's some days and you can test it, right? You can test it, not just say, I think it's going to move on this day, CPI or PPI or Fed announcement, FOMC. You can test it, right? It's like the movie Moneyball. You can test it and see, what matters there, right? Now, today, why am I not playing, right? Well, you have Nvidia, which is 8% of the SPX, is coming out with earnings tonight after the close. And I would say on a 1 to 10, it's a 7 to 10 catalyst. It's something that, especially because of the industry, and Nvidia it could move the market 40 or 50 points, right? It could move this maybe too far on some of these trades. So on a range-bound trade like this, I can pause it in automation for today, right? Now, in reality, what do? I would test it. I'd go back and test it during the Nvidia and see how it goes, right? I mean, I have this triggered to go daily. So I'm just missing one day, right? As an opportunity to put this trade on. But it's to me, I would consider it a pretty big potential catalyst, but you want to back test it. You don't want to just pause trades for no reason. I don't want to pause trades or not do something that the back test has shown is a good strategy unless I back tested it, which is good. I just put here, allocate 10% of the portfolio in the back testing. And with the bigger allocation, it'll kind of highlight some of these things, especially like the drawdown and different things like that. I have an RSI minimum 60, so trying to get a little bit more range bound, not too crazy of an environment. I have exit trades at 1:58 p.m. on expiration. You say, Dan, you don't have a profit target here. I don't. It's kind of letting in the back test, let it run. But I do have some rails or risk management techniques. And again, they address, right? And we'll look at those a little bit closer. And they address your two biggest concerns in a double calendar. Price moving too far. So I have this exit using leg deltas. When the delta of my short put or short call goes too high, right? I'm starting out at like a 28 delta on the puts, 29 delta in the calls. When those go too high, I want to leave the arena, right? And then exit when the short-long ratio goes below 0.1. When the premium's kind of sucked out of this thing, especially in the shorts, I want to leave, right? So these are I'm addressing both of my concerns with these exit rails. And then to make it realistic, the back testing, I'm including opening and closing fees, realistic, entry and exit slippage that I'm not just taking for granted like I'm getting filled at the mid every time. And I also have one more thing. I want a minimum short-long ratio of 0.45 when I come in. And that's just saying, I want ample premium here in my shorts. I don't want to come in with an environment where all the premium sucked out of my shorts, right? Too much in my longs versus my shorts. So when I tested this, you could see starting capital, ending capital, and capture rate. You can check out Option Omega. They have great documentation section. You can check all these. They have free boot camp back testing, and you can go and learn all about this. But these are important. The MAR ratio is 3, win percentage 68.5, capture rate 10.5, average days in trade 6.5, plenty of trades. So again, you're going to get, usually in these double calendars, a pretty good win percentage here. And you can see they have the log here, how it's done each year, some different graphs. And you can see trade log. As I said, these are around $50, this particular one. And then they'll give you reasons for close. Again, I had 2 exits below short-long ratio or above a delta. And let me just go over those real quick before we get to the automated test. You can see here, this is actually setting up the back test. So you put in here, if you look, I've got from 2020 all the way to yesterday, right? 2025. And then you've got, this is the actual back test. I'm selling a put, selling a call. These are the deltas. And then you can see your longs are 23 days out versus your shorts 9 days out. Progressing down the line here. Margin allocation 10% per trade. This is the back testing. I'll show you the actual, what I have set up for the automation in a second. So starting fund 100,000 for the account. And this is obviously, if it's in the back test, it's just paper. I mean, it's just how you want to test it. And it has entry time 12:35 p.m. Use technical indicators, a minimum RSI of 60, no profit target or stop loss on this particular one. Doesn't mean you can't use one. I'll show you something to say. If I put in a profit target of 10% on this, it still looks pretty good results. The win percentage will go up almost in the 80s. And I could show you that in a second. Use early exit. Early exit time on day of expiration, 1:58 p.m. But this is the nice rails they have. Use delta. I'm selling a 28 delta put. When that 28 delta goes to 65 and the option starts going in the money, the SPX is going through the short strike. Houston, we got a problem, right? And we want to get out, right? Limit our losses. On the short call, our 29 delta, when it gets in the money, goes to 65. I want to exit. So those are very strong rails. Again, for the price movement, for the volatility, in the extrinsic value time premium, use short-long ratio. Exit when the short-long ratio is below 0.1. When there's not much premium left, get out. Here this is called an Option Omega, the Punisher, that you're putting strong, making it as realistic as possible. Entry slippage, exit slippage in SPX, commissions and fees. And then also, here's another one, use entry short-long ratio. I want a minimum of 0.45 to get in this thing, right? So I'm not going to come into something where there's not much premium in here. So that's the back test. So now I say, hey, I like the back test. Hey, I'm comfortable with that. I am going to, automate it. And it is automated, right? Now in automation, there's some changes or some additional things. You could say, I'll adjust every 0.05 for a price, every 5 seconds up to 10 tries. That we're going to try, we have a two-minute entry window to get this thing filled. And I'm going to adjust 5 cents for every 5 seconds up to 10 tries. And then here's some exit, just how we're going to get out of the trade. And you can see here in the edit straight, so this is the actual one to be fired up, right? And you can see here, though, I just put fixed quantity max one contract, max one open trade. Just going to have, even though I have this to enter, and I tweak this in the, I have this going every Monday and Wednesday, right? A little bit different from the back test, but every Monday and Wednesday, and that test just as well, I'm putting it at entry time 12:35, but I just want one open trade. So if I put one on Monday, Wednesday comes and I'm still in it, that's all I'm going to do, right? And you can see Monday and Wednesdays, and I have used technical indicators, minimum RSI, talked about the minimum short long ratio and everything like that. So, and there's the deltas, all the tests that I have in the back test. The only different thing is exit execution, right? Which we talked about. And I'm putting this on Mondays and Wednesdays versus every day. And here just doing one max trade. So that's the progression from what is a double calendar to does the strategy work? Did you back test it? Yes. And then if you did, you automate it. For me, one of the great things about automation just frees up your time. You have a tool that thinks like you do, that especially like with risk management, Option Omega has these rails that when price moves too far or volatility isn't going your way, which are your two big risks with range bound trades, it can get you out. And that's key. You have to have risk management. You can't just hope. So folks, I hope this helped you a little bit. Have a great day, and we'll talk to you next time in the double series.